Greetings and welcome to the Nova Leap Health Call. It is now my pleasure to introduce your host for today, Mr. Chris Dobbin, President and CEO of Nova Leap Health. Thank you. You may begin.
Thanks, Rob, and welcome everybody. Appreciate you taking the time to learn a little bit more about Nova Leap. For those that are new to the story, and for those that are have been following along, welcome back. I'll flip through the slides fairly quickly. I'll try to leave as much time for Q&A as I can. I would say anyone that wants the presentation's available on our website at novaleaphealth.com. I think we've done a fairly good job of updating it as our quarterly numbers have come out. I will say I'll stick to historical numbers here for the most part. We do expect to release Q2 results hopefully by the end of this week. So for those that are looking for our most recent results, stay tuned. I'll also give an update as best I can on the industry as it relates to COVID, just in terms of what I've seen from an industry perspective, which I think is useful for people to understand the impact it's had on companies within our industry. So, what do we do? Nova Leap's a home care services company. We operate both in Canada and the U.S. We started operations back in 2016. Been fairly active as an acquiring type company, made a number of acquisitions over the last 2.5 years in particular. Have a predominantly geographical focus within New England, Nova Scotia, and most recently in South Central by way of an acquisition in Oklahoma. Our company focuses on what we call a private duty or private pay side of things, meaning that we're not a Medicare or Medicaid type service in home care. So if you were to sort of look at our revenue, generally between 75 to 80% would be, even upwards of 90% would be a private pay, so out of pocket by the seniors we provide service to or their adult children. And the remaining, call it 10%, would be a combination of veteran affairs, which is government pay, or long-term care insurance. So those are the sort of three ways in which we receive payment. Again, mostly a private pay, so not Medicare, Medicaid. So, what's non-medical and what's referred to as skilled, which is often the difference between home health care and home care. Home health care, which is a very small portion of our business, again, on the private pay side, would be, skilled nursing, med pours, wound care, things of that nature where you typically need an RN or a physician to oversee care. On the home care side, which is where the bulk of our business is, and it's really in the non-medical side of things, so medication reminders, dementia care, which is a very large portion of our business. 75 to 80% of those clients we provide service to at our various agencies, live with a form of dementia. So it's probably our largest focus as an organization is on dementia care. But mobility issues, personal grooming, again, medication reminders, meal prep, physician visits, and so on. Those are all transportation errands. Those are all part of home care and things that we do quite regularly. If you look at the home health care industry, Medicare and Medicaid by far make up the largest portion of the home health spectrum. Again, I'd say we focus on about 7% of the overall market, and that's based on the private pay non-medical side. What's driving the opportunity? I don't think I need to speak to the demographic shift that's happening. I think most people have probably heard the numbers of 10,000 individuals in the U.S. alone attaining the age of 65 every day. That's going to continue for the next number of years. And so really what we have here is an aging population. We have a prevalence of chronic conditions, meaning long-term health care conditions, and those two things are leading the need for care. And then when you think about, where does care happen? It happens in the home, it happens in, assisted living or nursing facility, or in the hospital, in the acute care setting. And, what the surveys what they've indicated is that most seniors want to remain in their home if they can do that. And it makes sense, right? You have a situation where you raise your family there, you're very comfortable there. It's what you've known for many years. And so I don't think it's a surprise that people want to remain there. And I think the good thing is that government policy is beginning to dictate and has been dictating for a few years that there's a movement to care within the home, and that's driven in a large part by economics, because you have a situation where if you're providing care within somebody's home, obviously you don't have high overhead costs that you would have with an acute care setting, and so it's a more efficient way to provide care. With COVID, and this is why I think the industry is so well positioned going forward, is because unfortunately you look at where the deaths have happened, and a large percentage, and certainly the news coverage has indicated that a large percentage has happened within facilities, right? Once the virus has been within the facility, it's spread fairly quickly. And so if you think about a loved one within a facility setting versus in a home, obviously within a home you're already in a setting where you're sort of isolated from other people. And I don't mean isolated from the fact that you don't have care or you don't have access to loved ones, but you just don't have as many people that are sharing, common areas, and whether it's restrooms or cafeterias and so on. So I think there's an awful lot of facilities out there that have done an excellent job and probably don't get the recognition they deserve. But a lot of the headlines these days obviously are about the deaths that have happened. And so again, we've received a number of calls from people looking for home care as a result of not wanting to put mom or dad within a facility. And so I do think that from an industry perspective, I think we're very, very well suited going forward. I'll skip over the Alzheimer's dementia. I talked about that. We again, 75% to 80% of our clients live with a form of dementia. It'll continue to be a large focus going forward, and we spend a lot of training for caregivers in that aspect. 3 ways for us to grow. Organic growth, an example of that would be the Ohio location. We just opened outside of Dayton, Ohio in April. And, interesting time to open a brand new location, 2 weeks after a pandemic's been declared. But we've got a senior person that we feel pretty comfortable with that'll lead the way. And so it's one of those situations where you go into a new area, you have a new person looking to make new referral sources and generate business from scratch. But that is a way that we think will be a larger portion of our business going forward, and one that we think we'd be quite successful at. And we don't think there's a lot of risk. We think there's a very, very high return on investment. We think the capital outlay is pretty reasonable for us. Acquisitions, which has certainly formed the largest part of our strategy thus far, will continue to be a very large part of the strategy moving forward. We're very active in a number of discussions with acquisition candidates as we've been over the last 2 or 3 years, whether it's driven by COVID or not, but this seems to be a very, very active time with a number of opportunities in front of us, so we'll see where those pan out. But certainly as part of our strategy, we continue to make a number of acquisitions. I'll talk about what we look for in a later slide. Joint venture partners are one that we haven't done yet. I've spoken to this in past presentations, but there may be opportunities for us to partner with a hospital, for example, or other type of tech company and so on. So we're always in, looking at opportunities, some that are presented to us, some that we seek out, just to see whether or not there's a fit that can help us grow as a company and provide better care to our clients. So from a revenue growth perspective, I'll show 2 slides here, which I think are important. One back in 2016 is obviously when we started as a public traded company, and we generated $40,000 of revenue, which is almost non-existent at that point. I always had a question of, why did we become a public company? And my view was, and still is, that we become a large public company over time, just given the sheer volume of opportunities I think that'll exist in the coming years. And so obviously we're still a very small publicly traded company. We've grown significantly over the last 3 to 4 years from inception. But if you're to look at them, and those are large gaps. But if you look at the next slide, you don't see the gaps as large. And so I always talk internally and as well as externally about incremental changes that we make, and we do a lot of small things really well. That's my belief, and I think that's why it's led to significant growth over the last few years. As we've made acquisitions, and again, it's one thing to make an acquisition. But in order to make a number of acquisitions, as we have, you have to make sure that we're integrating successfully, right? If we weren't integrating successfully, obviously we would not be as successful as we've been as an organization. And so I think we've done a fairly good job of integrating. I think the leadership teams that we've acquired as part of the acquisitions, the personnel, I think have been excellent. I'm completely satisfied with the team that we have, and so that's why I'm confident with our ability to continue to execute on acquisitions that we make as we continue our expansion plans. From an EBITDA growth perspective, again, it's been similar. Obviously, as we started, we were reporting negative EBITDA as we achieved a certain amount of scale. I think one of the things we've reported have been, our obviously, our revenue has been growing. We've shown our EBITDA growth. We've demonstrated as we scale the head office costs that come down as part of a percentage of revenue. So as our organization, we're very decentralized. Our local managers and authorities within the agencies that they operate or the regions that they take care of, the cost center that exists is really the head office out of Halifax, where we've consolidated our accounting function, where we run our M&A activities and so on. And we don't need to add, many people to the head office as we continue to expand. We still have capacity within the head office. And so that's why we've continued to report, and people have seen sort of this declining number in terms of percentage of head office cost to revenue, which we think will continue as we scale. So the EBITDA growth has been good from an annual perspective. From a quarterly perspective, which we also typically put out in our press releases every quarter, looks very much like a stock chart. Sort of goes up, has a bit of a settling, it's going up to the next level. I think it's pretty healthy for the company. One of the things that we did at the tail end of 2018, after we'd made 5 acquisitions that year, we sort of took a pause, right? Made sure that the operations were working as we wanted to. We were integrating properly. We were implementing technology across all the agencies, improving some of the processes, and then we started going back in 2019 where we made 3 acquisitions. So, as an organization, we're not scared to take a pause if we need to, right? If we see the right opportunities, we'll act on those. But if we've made a number of acquisitions, we want to make sure we get those right. They're operationally they're continuing on as we think they should. Then again, we'll take the pause if required. And again, I think it's pretty healthy for an organization that's growing as quickly as we are. Again, my favorite part of the presentation for those that have heard this in the past is the map. All those little dots are indicative of the operations that we have right now. So in the top right, Nova Scotia with 3 locations, number of locations throughout New England. So you're looking at Vermont, New Hampshire, Massachusetts, and Rhode Island. We do have the one standalone dot there in Ohio. We just opened outside of Dayton. Again, that was the organic growth location. And then in Oklahoma, about an hour, 45 minutes outside of Oklahoma City, we have 2 offices there. And again, this is an acquisition we made last October. One has actually been quite successful for us, so we're pleased with that so far. On that map, again, going back to it, I'll just say that, if you look at where we've come over the last 2.5 years, I think it's been fairly significant. But what the map does demonstrate to me is all that space that we have to grow, right? And so if you think about over the next decade in terms of where Nova Leap is and where we could be, I think there's a tremendous opportunity for people to get involved in our company now, which is why I'm touting it so much, which is why we have insider ownership, which is why we've had insider lead multiple rounds, and again, why I think we'll be successful going down the road. Speaking of financing, we do not have a need for financing. We certainly don't have any plans anytime soon. I think we did a good job of our last raise with the convertible debt we did tail end last year and it closed in January, and so I don't see a need for financing at this point. What do we look for in terms of acquisition criteria? Pretty simple. I mean, we're looking for a 10 to 15-year-old business, ideally. Usually founder-led, so someone that started a business from scratch, has built a good leadership team within the office, which may only be 3 or 4 people, and then there's generally 75 to 80 caregivers in the field. That's what we're looking for. I mean, generally between 1 to 5 million of revenue. I mean, we'll go up to 15, we can go higher, but in the private pay space, it tends to be small. I like the small businesses. I think we continue with the small business acquisition strategy for now, and really in the foreseeable future. If you get an acquisition wrong, it's not high risk because they're small. If you get it right, then they can add quite a bit to your top and bottom line, as we've demonstrated through our EBITDA growth over the last 2.5 years. So again, we did look at one turnaround. We did actually acquire what I consider one turnaround way back till in 2017. But for the rest of them, they've all been EBITDA positive. Again, they generally have a 10 to 15-year track record, good leadership team. The comment there around operational synergies, we have consolidated the back office functions, as I've alluded to, in Halifax. We've rolled out a consistent technology across the system, which has been good for us, which ties in our scheduling, our billing, and payroll and accounting functions. We have managers that have been promoted within the organization that have taken leadership roles. Instead of just looking after one agency, you can now look after 2 or 3 agencies, which has been good for us. And so those are the types of things we look for when looking for acquisitions. The management team, I'll skip over this quick just in the purview of time. We do have 4 directors. I'm one, and we have 3 independents. Again, this is on our website. Our cap table is, from my perspective, pretty simple. 65 million shares outstanding, 77 on a fully diluted basis. 38% insider ownership I've alluded to. We do have a Bank Montreal, which has been a terrific financing partner for us as we've been making acquisitions. We haven't utilized bank debt since transaction till 2018. So it's been about 1.5 years since we utilized bank debt, but again, a terrific partner for us when we need them. We do have some options outstanding that are generally for those in leadership positions within the organization, and then some warrants that are a result of past transactions where we did have some brokers involved. From a comp perspective, the larger companies we tend to follow are Medisys, LGC Group, and Addison, and they do differ from us in a large way, and that's they tend to be Medicare, Medicaid, or hospice focused, so a little bit less on the private pay side of things. What I found in discussions with various people within the industry is that, and I've heard this alluded to directly from one of the CEOs, is that they struggle with the smaller transactions. Obviously, it doesn't move the needle, but they're really looking for larger companies that achieve scale. I would say they trade fairly healthy. Last numbers I looked at, they were trading, actually, I think the end of June, so up to the slide, they were trading at, one of them was about 30 times EBITDA and about three times revenue, I think. So they're very healthy at the moment, and that's, again, just driven largely by the outlook for the industry. So I think we're well positioned, as I alluded to, from an industry. I think we're well positioned as a company, very comfortable with the leadership team that I have across all the agencies. And when I look back in terms of when I founded the company back in 2016, I think, do I have the same sort of confidence that now as I did back then, and really, as I think about what we've accomplished over the last 2.5 years, which has been significant, I'm quite bullish on the outlook of our company, and very confident with where we stand and what we're trying to achieve as an organization. So with that, I will happily take questions with the last 5 or 10 minutes that we have left here. So let me just flip over to Q&A and see if I have any questions. All right, first question. What's the inflection point? What is inflection point has either happened thus far in 2020 or investors should look out for? Yeah, great question. I mean, look, I think for us, I mean, obviously we've been in the midst of COVID, and I think investors should rate us on how we've performed through COVID, number one, right? So again, we should have Q2 results coming out here at the end of the week. And as I've indicated, we have a number of discussions on the go for acquisitions. We've been acquiring type of company. And so I think as you look at how we've managed through COVID and the state of our affairs when they come out, I think that's one. Two, as we continue to make acquisitions, and certainly I expect to continue to make acquisitions, and then you look at the fact that we don't actually have a need for financing at the moment, and think about a very fast-growing company that's EBITDA positive, it doesn't need financing, has demonstrated the ability to buy good companies at great valuations and actually operate them well post-acquisition, then I think, certainly if I was an investor, I'd be thinking about, is that a good opportunity? And as a person that has made significant investment in the company multiple times, then I would answer that yes. So we're a very easy business to understand, right? We do the same things over and over and over, and I think that we do them very well. And so I think you'll continue to see that going forward. All right, let's see if there's any other questions here. Let's give no other questions here, but I'll give another 30 seconds to see if there's anything else that people want to ask. Rob, I don't see any more questions here.
Okay, would you like to make any closing remarks?
Yeah, look, I mean, two types of remarks. One is for those team members that may be on the call. I know some have joined in the past. Again, just very proud of the organization that we built here and the people that are leading the organization at all the agencies and the staff. It's remarkable what we've done through COVID to keep our clients and our staff members safe, and that's really been a focus since the pandemic has started. To the investors on the call, for those that have been with us for some time, stick with us. I think we're in good shape. For those that are new to us, thanks for joining in. I appreciate you taking the time of your day to listen to our story. Again, I think we're an easy business to understand and one that whose track record we plan on sort of repeating. So again, I appreciate everybody taking the time today to join. Let me just one more question here. So cash flow positivity is key to building a strong organization. Can you explain at what point you will achieve this objective? Yeah, look, stay tuned for Q2. We're obviously, as we start, if you circle back to the history, obviously, where we were, negative EBITDA all the way to positive EBITDA, we demonstrated our ability to continue there. Then we were hitting operational cash flow positive. We continue to be operational cash flow positive as we reported results. And so the difference between being operationally cash flow positive and free cash flow positive was really just the debt that we have had. And I think we've been fairly aggressive in terms of how we've paid down that debt. One is the bank financing. Again, that's been, it shows as a demand loan on the balance sheet, but is amortized over 5 to 7 years. And so we've done a good job of paying that down. But one of the things historically that has taken up quite a bit of our cash has been the promissory notes. And so this is part of the way that we've grown so quickly is we've had seller financing, what we refer to as promissory notes or seller notes or vendor takebacks, depending on the terminology you use. And if you sort of look back at the schedule of those, we were generally paying those off over a 2-year period. And this year was a big year. So 2020 was actually a big year for us in terms of getting by the majority of those vendor take-back promissory note payments, and we've done that. And so I think that really bodes well for us as we enter into the last part of this year, and particularly in 2021, where we won't have the same level of promissory note payments we've had over the last couple of years. So again, if I were an investor, I'd be taking a look at how we've done from an operational cash flow perspective, which has been good, and then take a look at the debt's been paid off, and particularly promissory notes, and the impact that'll have on our cash position as we move into 2021. Great question. Thank you. I think that's it for questions. Thanks, everybody. Really, really appreciate the time.
This concludes today's webcast. You may disconnect your lines at this time, and we thank you for your participation.